Hi everyone, my name is Hannah. I'm going to be presenting to you this evening on mortgages. It's the flavour of the day, right, with the OCR or lack of OCR movement. But we're going to talk about, most importantly, how you can get rid of your mortgage, how you can start to grow wealth, and how you can turn what is probably the most unproductive financial asset, your home, into something that starts to work for you. So a few questions have been submitted ahead of time. If you do have questions as we go, please pop them in the Q&A button and they will be collated by the producer at the end, and we'll try and get through whatever we can. We're going to be recording tonight's session. Those who feel inspired will be able to benefit from a one-on-one consultation with one of our amazing advisors. That's discounted if you want to take advantage of it, or if not, you can just sit back and relax as I try and wow you with perhaps the most boring topic of all, money. But we've got quite a bit to get through. So I'm going to kick on. We're going to talk, in amongst these slides, we're going to talk about the OCR. So as you know, no movement. I'll talk about what that means and how you should be thinking about structuring your mortgage later on. We're going to talk about the mortgage realities in New Zealand. We're going to talk about strategies to accelerate paying your mortgage off faster, how you can build your wealth through leverage. And in this context, that means using the equity you've got in your home, how you can start to repurpose that so it works hard for you. And of course, all these things have risks. So I want to call those risks out, but I also want to try and show you the lane that you might be able to play in if we think about this a little more strategically. And then we've got a couple of client stories who have moved from good to great, and then I'm going to take some questions. So my background, I'm a chartered accountant, I'm a financial advisor, I've got my master's in tax, I have a personality, but I founded Enable Me close to 17 years ago. And what preceded Enable Me being formed was me getting my first mortgage. I think it was a few years before I'd got that, maybe I was in my early 20s. In any case, I did what everyone does. I played the banks off against each other and I got a really good interest rate. But on my $350,000 mortgage, that's how you know that it was 20 odd years ago, I was still going to be paying almost $1 million back to the bank, right? So almost 3 times what I was borrowing, I was on track to repay. And the interest rate discount that I had negotiated, yes, it was going to save me over the life of my mortgage, maybe $10,000. So, you know, that's a little bit, right? But not $1 million. And in fact, when I first worked out the interest that was getting charged, I thought, is this even legal? And it's compound interest working against you. And I thought, clearly paying my mortgage off, well, how do I pay it off faster to save myself some costs? And this next conversation led to Enable Me getting formed, because what I did is I called the bank and I said, okay, well, how should I structure my mortgage so that it can be paid off faster so I don't pay as much money in interest to you? And they said, well, you can shorten your term of your mortgage, right? Which means you increase your monthly fixed payments, but you pay less months because you finish earlier. And I'm like, well, whilst that makes sense, there were some months I couldn't comfortably manage the minimum repayment. So the idea of committing to more and locking myself in to the point where you get penalized if you can't maintain it, that felt kind of reckless and uncomfortable. And so I thought, well, what are your other options? And so I asked them your other options. And they said, well, if you want to be able to make payments against your mortgage as you can, as opposed to committing to the same amount every month, well, then you need to have a portion of your mortgage on a floating interest rate so you can make those payments without being penalized. And I said, yeah, but a floating interest rate is 1.5% higher than a fixed interest rate. So there's got to be a point at which the benefit of having the flexibility to pay off is offset by the cost of having the flexibility, right? I asked them if they could tell me that point, and they couldn't. And I'm like, well, what if I want to get access to the money? Because if you're like me, you show initiative, you put some money against the mortgage, and then sure as eggs, within 48 hours, you'll need that money for something else. That's just how life works. How do you get that money back? And they're like, well, if you have paid it off, you need to make a full application to the bank in order to release that money again. And I'm like, well, that doesn't really work. So I hung up that call because that was boring, and I thought it'd be great if I could work out how to structure my mortgage to pay it off as quickly as possible at the lowest cost, certainly, and having the most flexibility, because life is not linear. How do I do that? And that's when I made my second call, which was to the calculus department of the University of Auckland. And I asked them if they would help me work on a formula to structure my mortgage to pay it off as quickly as possible at the lowest cost, maximum flexibility. 8 pages of calculus later, we had a formula that would save me the size of my mortgage in interest costs. So for me, that was 350 grand. And I patented that formula. But for the formula to work, I had to have money left over that I could put towards the mortgage, which makes perfect sense, apart from the fact I didn't have any money left over. So I was earning the most money I had ever earned. I was financially literate. I was sticking to a budget. I could color code a budget if you want me to. Or stick to a budget at work. On a personal basis, I wasn't that inclined to stick to a budget because, as it turned out, my tendency is I prefer to shop rather than save. So how do you make someone like me get ahead? And that became the answer that then translated to Enable Me being formed. And our job is to work out, firstly, what is the problem we're trying to solve for you, for me? What is the strategy we need to look for? And let's be as creative as we can with trying to create the right strategy. And then let's execute on that plan. And that is how Enable Me started. And so that was 17 years ago. And since then, I think we've worked with close to 20,000 clients. So we know what we need to do if we're serious about getting ahead. And that's what we're going to go through tonight. So today is general in nature, but I hope that it's specific enough for you to work out what's relevant to you and that there are more paths available to you than what you possibly first thought. And if I can encourage you to take any step forward, then that would be a success. So to kick things off, I need to understand a little bit about you to make it a little more relevant. So the first thing I'm going to ask is, are you mortgage free? If the answer is yes, please say yes. If you don't own your home, say that, so you don't have a mortgage yet. If you are not mortgage free and you've got either more than 15 years left or less than 15 years left that you're on track to have it repaid, or you are mortgage free on your home, but not on your investment properties. I just need to get a sense of what I'm dealing with so I can tailor the content to keep it as punchy and relevant for you as possible. So if you could do that, I would be grateful. Okay, so we've got 60, so the vast majority, 80% of us haven't paid off the mortgage. 64% have more than 15 years to go, and 18% have less than 15 years to go. Okay, so that gives us a good place to start. Because I always think in life's painful enough, let's be honest. If we're going to put effort into something, let's make sure we're solving the right problem. And I think too often with money, we focus on the wrong thing to put effort into. And it's not that what you're doing is bad, and I guess effort is good, but effort is a limited resource, right? So you want to get the biggest bang for that effort as you can. And that's what we're going to start to frame up for you tonight, and how we think about money and how we think about creating success and momentum for our clients. And momentum is probably one of the most special words we're going to talk about. But we all want financial security. When you're in control of your money, or you don't need to worry about money, it gives you peace of mind and it creates options. It means you don't have to do a job you don't like, or you can afford to be paid less to do a job you love, right? That comes from financial security. Financial security gives you the ability to stop working, which could be voluntarily during kind of your working years, or it means that you can stop working with confidence when it comes to retirement. These can be quite uncomfortable things to think about when you've got less than 15 summers to go before you retire. When you're financially secure, you can follow your passions. It gives you the stability to navigate volatile times, and it gives you independence. So financial security is a good thing. But how do those things present themselves? Well, it shows up in different ways, but we believe financial success, which is the offshoot of being financially secure, means that you are in control with a plan. You are mortgage free, or you are on track to become mortgage free within the timeframes you need to be mortgage free so that you can unlock the next stage for you, which normally is retirement. Financial success means that you have a wealth creation plan in addition to your mortgage repayment strategy. And for many of us, we also have a cash savings target that needs to be layered in as well. Financial success means you are set for retirement. And if you want to be particularly ambitious, it means that you've created financially independent children. But the reality for most of us, our mortgage payments account for almost 50% of the income we receive, right? So we might be earning good income, but on balance, 50% of that is going right out the back door towards the mortgage. And for most of us, that's paying off over a 25 or a 30-year term. Almost 60% of us are stressed about that level of commitment. Certainly, if you're having to pay that, it's taking that much of a chunk of your income, and you might need to make renovations on your home or do other things that's also going to require your income, that can feel like you're hamstrung. And being financially hamstrung that's an uncomfortable feeling, and it creates stress. And that stress either plays out in your health or typically your relationships, right? So it goes somewhere. And they say that your body keeps score, right, of these things. We know that 23,000 mortgages in this country have fallen behind. The average first home mortgage is 550 grand, up from 300 grand 10 years ago. What does that mean practically? Well, it means that in the last 10 years, the house price has doubled, but income hasn't doubled. And so what that means is you need to save a bigger deposit, and it takes you longer to do that. And therefore you're entering the property ladder at a later age. The average age people are getting their first home now is age 36. In my grandparents' day, it was closer to 20 was the age, right? So that movement then has other problems. If you're getting onto the property ladder later, it means you have a mortgage for longer, and you're not mortgage free by retirement, right? 36 years plus, if you buy at 36 and you've got a 30-year mortgage, that means that you have to work till 66 just to be mortgage free. And in addition to that, that means that you're staying in that first home for the rest of your life, and you're not upgrading. And you haven't saved for retirement outside of your KiwiSaver, right? They create problems that we have to deal with in a different way. We know that 135,000 people over the age of 65 have a mortgage, and the majority of new mortgages are 30-year term. So this is the reality. The reality is neither good nor bad, but we have to respond to it in the right way. And back in the day, they could say, well, if you just delayed your gratification and if you spent less than you earn, that will be enough to solve your problems. They said that because when they said it, it was true. That's what my grandmother used to say, and she could say that. My grandparents, like your grandparents, would have been mortgage-free in their 30s if they had bought a home in their 20s. Not because they were good with money, but because the house price relative to their income was only 2 times their income, not 10 times their income. So what that means is there's more money left over that can pay the mortgage off faster. And as long as you're not a dud, you are going to be mortgage free in your 30s, right? And so what that meant is that they then had 35 years to save for their retirement. Amazing. And they didn't have, I guess, desires above their station, and there certainly wasn't credit cards weren't even invented then, and cafes didn't exist. There was no ability to spend more than what you earned because there were just no options, right? So that the realities have changed. We've got to be able to work with that. And so then with finance, you've got things that you can control and things that you can't control. The OCR is an example of something that you can't control. What we know about the OCR is that it's flatlined now. In the next 3 months, we expect rates to come down by another 0.25 perhaps. Well, the OCR to drop by that, whether that feeds through into rates, don't know. The rates are probably close enough to the lowest they're likely to get. Maybe a little bit more movement, maybe the slightly longer term rates could come down. But there is going to be potentially a small drop between now and the end of the year. So from an interest rate perspective, on the assumption that you're staying in your home for the next couple of years, there's an argument that you could fix for 6 months and then fix for slightly longer. Whether that argument is true for you depends on what interest rates the bank are offering you. Because if you're fixing for a shorter period of time, you're going to pay a higher interest rate on the assumption you get a lower interest rate when that comes off than what is getting offered now. So if you're confident that that's going to happen, and maybe we could say, well, yeah, I'm fairly confident that it should drop by another 0.25, perhaps. Well, for that to make sense, you need the gap between the 6-month rate that you're fixing for and the 1-year rate to be 0.4%. So if I looked at ASB rates before I hopped on, and their interest rate is, the 6 months is 5.29%, and their 1-year rate is 4.89%. So the difference between those two is 0.4%. Under that scenario, it actually works out cheaper. So if the gap between those is 0.4 or more, it will be cheaper to fix now than to fix for 6 months and fix in 6 months' time at a 0.25% lower than the 4.89. So the key here is the ratio, sorry, the range, the difference between the rates determines whether it's in your interest to fix now or not. If the 1-year rate is more than 0.4% lower than the 6-month rate, you are better to fix for 1 year rather than ride it out. So the question you ask your bank tomorrow is, what are your best rates? And you can look at that to see whether that's what's going to be the right one for you. But other things you can't control. No one can control what's happening in America, Ukraine, Israel. There's a lot. The market goes up and down. Normally the difference between a good outcome and a bad outcome, or a bad outcome and a good outcome, is 18 months. It's provided you're not forced to drop your pants at the wrong time and you can hold on, you normally can weather market corrections. But most of us tend to have to drop our pants, or we get so nervous to keeping our pants up that we just run away. I don't know what happens, but we don't have either the confidence or the financial tolerance to weather some of those storms. And we've got to get better at some of those things, but there are things you can't control, but your ability to weather it is something you can control. And that is your financial resilience, which we'll spend some time building in a second. We can't control what the government does, the cost of living crisis. I mean, some of these things I'm so sick of talking about. It's like, who cares? In spite of that, you need to be able to get ahead. In spite of the challenges, your household needs to be financially successful. So let's focus not on the things you can't control, but what we can control. We want to cut through all the noise and start with you. We want to work out the starting point. Where are you right now and what do you need to achieve? Well, I know as a minimum, you need to be mortgage-free by retirement. As a minimum. If you want to help your kids into their first home, well, I need to add that to that. And I assume you want to be able to retire at some point as well. And the pension is unlikely to cover the shortfall. So that there's a financial implication to that. And I need to understand all those things added together to work out, well, what is the size of the problem I'm trying to solve and how long do I have to solve it? We need to look at what your tendencies are with money, because that will tell me what strategy is going to be effective. If you are a shopper, you can tell a shopper to spend less money. They're just not inclined to do it. So that's not an effective strategy. You've spoken the truth, you should spend less, but unless someone's going to engage with it, well, how useful is that? You've got to work out what's going to be useful for who you are and what you're not. I'm a shopper. My husband's a saver. He loves being frugal. Well, I won't go too deep there. He's the type of person that will turn the lights off when he leaves a room. Probably a good thing. I like to have all lights going. I like everyone to know I'm home. But he goes so far as turning the lights off when I'm still in the room. I'm like, Bill, what are you doing? You know, savers are just a little bit weird. But if you are a saver, of course that gives you a head start. Like if you are programmed to not be wasteful, all power to you. It doesn't mean you're very good at growing wealth, but you definitely have a head start. And if you were living in my grandparents' time, you would have been fine. But now we need to not only be deliberate with our money, but we also need to get it working hard. And that's where a shopper becomes a whole lot more effective, because what a shopper is good at, they can bring their A game. You just got to make it worth their while. And if you can't make it worth their while, then why should they bring their A game? Why would you put effort in unless it's actually going to create an outcome you want? You do that with everything, right? So if I start with your tendencies, And I'll kind of zip through this. We've got your money personality, your cash position, and your approach to risk. These are the three main categories we look at, but we have another kind of 6 or 7 subcategories that we'll pay attention to when we're working with you. So if you're your money personality, you're either a shopper or a saver or somewhere on that spectrum. I don't care which you are, but they have a different strategy. Shoppers, well, I like to think we're more fun, but we tend to be more generous or more relaxed with our spending. We don't have to spend on ourselves. We're happy spending on anyone, and we don't have to spend big amounts. Little amounts often is still a shopper. A saver is someone who needs a reason to spend. That's a true saver, that they are so happy not spending, they actually get energized from seeing their savings balance increase. A shopper doesn't. They genuinely do not get excited by that. They can be excited by their mortgage balance reducing, but not by savings. It's kind of weird. We don't care what you are. Where you come together is always interesting, right? Like the shopper married to the saver, oh my gosh. Or the shopper married to the shopper, having a good time, looking good, probably going nowhere, but would be a great friend to have, right? The saver combo, well, they are tight. And sometimes they save at other people's expense, which as a shopper, I feel quite put out by. But I won't dwell too much on that, but it's about what's an effective strategy to engage you. And when you do have different tendencies than your partner, often having someone to help you navigate that is the fastest way to get a different outcome. But your risk position is you're either risk tolerant, you don't like to take risk, or you kind of need big risk to find the energy. So shoppers tend to be not as good with their cash management, but they are definitely adventurers, kind of big, hairy goals and what motivates them. Whereas savers have the advantage, but they're also very safety conscious. So on one hand, they had the inside lane, but then when it comes to actually leveraging that position, they get a little bit standoffish. Kind of the worst component of all is the dreamer, who believes that the universe will provide and it will be okay in the end. And dreamers make great friends, but that is just not a financial strategy. Everything has an implication. So if you're a dreamer, or if you don't do anything about your retirement, you're not going to, I don't think you're going to die early as a result of that. But so you could say everything is going to be okay in the end. But the practical side of things is that you probably won't be able to live in your home for as long as you want. You'll need to downsize. You might need to move locations. You probably can't help your kids as you wanted to, or live the lifestyle that you feel you deserve for how hard you've worked for the rest of your life. That's the impact. Is anyone dying off that? Probably not, but there is an impact. And I have worked with people who arrive at retirement and they haven't planned. And so we're trying to navigate furiously. What do we do? What levers do we pull? What order do we execute this plan in? And it can be really confronting. And if I guess we want to get ahead of that and plan, but there's an impact. Dreaming isn't good for a financial plan. And then we've got your cash position, not your equity position, but your cash. On a day-to-day basis, is there enough money coming in that's enough to cover your bills, or are you going backwards? You know you're going backwards because you're either eating into savings, using your credit card and you can't repay it in full, or you're using your mortgage line of credit to facilitate your position. That means you're sinking. Doesn't mean you're going to die, but it means you've got to detox pretty quickly, because you are eroding your ability to trade your way out of your position. Floating is when you're not going backwards, but you're also not getting ahead particularly fast. Most of us are probably in that position, and I guess you're in that position if you're not yet flying, and flying is defined as saving at least 20% of your income. So if you're flying, we want to get you flying as high as possible and more directly to your goal. If you're floating, we want to move you to flying. And if you're sinking, we move you to floating and then to flying. But there's kind of a combination of how we work to do that. And no matter where you're at, we normally want to run a 3-pronged strategy. So we want to maximize your savings. Your savings is the engine room. Your ability to save or live within your means is your engine room to be more ambitious. We want to start paying down your mortgage, because the sooner we can get rid of those mortgage payments, the faster you will be able to save. And as you're paying down your mortgage, you're creating equity in your home. So the equity is the difference between your home value and the mortgage value. That gap there is your equity. As you pay off your mortgage, the gap increases, and you should be able to use that equity to start to grow wealth. And you either do that because you want to or because you need to. And unlocking equity for most Kiwis is a key component of their wealth creation. Because if you waited to create wealth until after you were mortgage free, the majority of us will not have enough runway between being mortgage free and retiring, so the income stopping, to save. Most of us do not have that luxury of waiting to save because we're just not going to get there. And that's assuming that you suddenly become good. So we're going to fix all that. So we spend a lot of time about focusing on how we maximize your savings. We're trying to do that as effortlessly as possible so that it doesn't create a grind or it doesn't become gritty. So we work to a plan. We work out where you need to be spending, what's important to you. So what are your non-negotiables? Because I don't want you to feel like you're on a budget, but I do need to work out where are you frittering money, because we fritter 15% of our income. We want to work out how we can maximize your income as well, but there's no point earning more if you just spend it out the back door. And then we need to create a system to capture that. And the cadence is how quickly we get that working. And the faster we get it working and the more we can save, the more reliable those savings, the more ambitious we can be. And we're trying to leverage the leverage and the leverage, right? So we're trying to get 3 layers of return for $1 of effort. Now, earning more does not translate to more progress, because a lot of people think that if I just earn more, I'll get ahead faster. That's sort of like, no way. As you earn more, all that happens is you relax. You're like, okay, thank goodness, I'm going to be okay. But with that relaxing, you get lifestyle creep. And what lifestyle creep might be, you upgrade the home, you upgrade the house, you send the kids to private school, or you just relax generally and you just spend a little bit more all the time. Earning more money is almost the opposite that's needed for financial success, because it creates a change in your psychology, which becomes quite dangerous, impacts your mindset. We believe financial success is 80% behavior, 20% strategy. Let's get the behaviors right, and we overlay that strategy on top. The behaviors are your engine room. Let's get that working, and then overlaying the strategies to pull you ahead quickly. You've got to see the pull ahead, especially if you're a shopper. Otherwise, you're like, what's the point? And I get it. So I spoke about fritter because most of us fritter income, and we tend to fritter it in 3 key areas, which is we spend a little bit more on our non-negotiables than we realize. Actually, there's a few ways where that's frittered. So I'm just going to explain the concept. You need money to be happy. You don't need an endless supply of money to be happiest. There's normally a point at which you derive happiness, and then if you keep spending, you don't get any happier. And I can do this kind of as a really frivolous example. If I have a cup of coffee a day, I feel good. If I have 2 cups of coffee a day, I feel better. I don't feel twice as good, but definitely maybe 1.5 times better. And if I have 3 cups of coffee a day, I feel sick. So for me, the optimum coffee consumption would be 1.5 cups a day. That's up to my maximum health, peak health for me. And anything I consume after that actually has a detrimental effect. So for me, the point of fritter, if I then translate that to money, if I buy more than 1.5 or 2 cups of coffee a day, it's not making me feel any better. So that's where my fritter sits. So fritter is about understanding, firstly, what's important to you. So it has to be part of the plan, and to what's the sensitivity of your spending level to derive maximum happiness. And your expenses fall into different categories. Like you have your fixed costs, which tend to be your bills or your kind of basic living costs, which there can be some fritter in there, but where most people tend to fritter is on how they structure their mortgage and their insurances and even their KiwiSaver. And I'm pretty sure the more you spend or give to the bank, I don't think you're any happier. So that's an obvious fritter. And the other area is on your discretionary spending. We spend a little bit more than what we think, more often than we realize, and that amounts to quite a big chunk of fritter. So when we're trying to design a plan, we start with, well, what are the things that make you happy? And you'll have a few things. Mine is I like my cleaner, I like overseas holidays, and I like my kids to have lots of opportunities. For me, they make me happy. And I know they make me happy because when I don't do those, I am not as happy, right? So it's not altogether that scientific, that measure. My husband's non-negotiables, which do not make me happy, are his Xbox games, his PlayStation games, and his art supplies, right? The key with designing a plan, understand what your non-negotiables are. Don't suggest to the other person where you think they're frittering. I don't think that's going to be a very worthwhile conversation. But start with those things, and then let's understand the sensitivity you need to spend. Most of us could eliminate or reduce our spending on any of those categories, and it saves a lot. So on average, we fritter 15% of our income. So as a household, if you had 100 grand coming in, 15 grand is lazy money, which could be your discretionary spend. The most common area of fritter is what you spend on groceries, to be honest. But it's your fixed costs, things like your subscriptions or some of your bills or how you pay that. There's a little bit of laziness in how we pay that sometimes, and it means we pay a premium. But the biggest area of fritter, which is quite convenient because you don't need to do much for this, we need to do it, is how we structure our mortgages, how we structure our insurances, and even just how the money starts to flow between our bank accounts. So we want to find the fritter because that unlocks a lot. And then we want to structure your mortgage so it can be paid off a whole lot faster. So why do we, what do we say here? Mortgage acceleration unlocks more equity. So mortgage repayment acceleration unlocks more equity, which allows us, if we've got everything set up correctly, to take that equity and get it working hard for us with other assets. So that's when we borrow against our home to buy something else. And arguably, you could buy any asset you wanted, but the most common and probably the safest asset, not as liquid, but the safest, is when you use that equity to buy an investment property. But for that to work, you need to know that that money's going to work hard and that you don't need access to it anytime soon. If I talk about how we structure the mortgage to start with, if you're on an $850,000 mortgage on a 4.99% interest rate, over the next 30 years, you'll pay that $850,000 back to the bank, and then you'll pay them another $789,000 for the privilege. If you got mortgage free in 15 years, you can do half of that, and if you did it in 10 years, you'd get $228,000. When we work with our clients, on average, we get them mortgage free in between 8 to 10 years. We know what we need to do, and we just get the job done. So if you've got a mortgage, you've got a couple of things. You've got, because I don't care which bank you're with. I don't like any bank, but there can be commercial reasons why moving to a new bank could serve your situation better. So you've got the option of refixing and restructuring at your current bank, or refinancing to another bank and restructuring. Those are your options. So refixing is just when you roll over the current mortgage and you fix it at a different interest rate. And if the rate between the 6 month and the 12 month is more than 0.4 of a difference, you'll be refixing for 12 months or longer. If it is less than 0.4, you'll be refixing for 6 months. That's the rule in today's market. But that's assuming that you are happy to keep with your current trajectory. If you want to pay your mortgage off faster, then we actually need to restructure the mortgage. And normally that involves breaking the mortgage into different components that allow us to pay off a chunk much faster. Let's see if I can give you an example. Have I got an example here? Yeah, one's coming up. No, it's not. So an example would be if your mortgage, let's say it's $400,000, you've got a cash surplus at the moment of $10,000. If you worked with us, we think we could get that cash surplus to $40,000 a year. We would structure that mortgage so that $40,000 was on a revolving credit type facility, that the whole objective of the year is to pay that to zero. And the balance of your mortgage, which would be $360,000, we would look to structure that normally over a 1 year, 2 year, and 3 year portion. And how it's structured is you pay off the overdraft, the revolving credit in year 1. The amount that was fixed for 1 year then comes off, and that's then slots into the overdraft again, and you pay that off the following year. And each year, where are my hands, the overdraft becomes deeper, or it's a larger amount, and you're capable of paying more off because the overall balance has dropped. So you just get faster and faster at it. That's one component that we need to be thinking about. But we're also thinking about, okay, well, we don't want your home exposed any more than what it should be. So if I want to unlock some of that equity, I normally would do that against the mortgage where your home mortgage is. And if I'm going to position you to buy an investment property, I'm going to go to another bank for the investment property mortgage so that the properties aren't cross-secured. These are things that we're trying to think about just as part of the plan. So if we're going to unlock and build equity, this is using the equity in your home. So let's say your home, I'll just use some round numbers because it's late. Let's say your home's worth $1 million and you've got a mortgage on it of $500,000. So that means you've got $500,000 of equity. Now the banks allow you to borrow up to 80% of your home's value, provided we can afford it. So that would mean that we could borrow $800,000 against your home. You've already borrowed $500,000, so there's a $300,000 facility we would be able to unlock if we wanted to. Now, with that facility, we could borrow that money to buy shares, a little bit risky, crypto, very risky. You could borrow that money to buy art, invest in a business, invest in property. I mean, you can use that money for whatever form of wealth creation you want. To start with, though, in the next couple of slides, I'm going to talk about investment property, and then I'm going to talk about the non-leveraged assets, which we'll talk about in a second. So depending on what strategy is going to be right for you will determine on what's the problem we're trying to solve and how big that problem is. Unless you give me another problem, I tend to be looking at, are we going to be on track for your retirement? And which means I need you to be mortgage-free, ideally without downsizing your home and ideally without using your KiwiSaver. And have we saved enough for you to live the lifestyle to which you are accustomed? And of course, we can squeeze that if we need to, but most of us want to give it a good shot. And so what I do is I work out, well, not me, our systems and our people, work out, well, based on what you're doing at the moment, when are you likely to be mortgage-free? And you did that 20 minutes ago, half an hour ago. And how old are you at that point? And how many years is left between you being mortgage-free and retiring? Whatever retirement looks like. And is that going to be enough money with your KiwiSaver to fund you for as long as possible? And if not, and the answer for 90% of us is that it's not, how much am I short? And if I'm short by more than $300,000, then you're going to have to lean into the investment property argument. It has to be the right property, and I'll say that 95% of them are probably not the right one. But you're going to need to lean into that because that is likely to be the most probable way that you would be able to close that gap if you do it correctly. Most people don't do it correctly, and a lot of people get burnt in the process, but I'm going to talk about what correctly means. So, do you know how much you need for retirement? That's one of the first things we work out in your initial consultation. Based on what you're spending at the moment, how much are you going to need? If we got you a little bit leaner, how much are we going to need? And what is the gap between those two things? But we need to know your number, and it's different for everyone. For some people, they are on track, and we've got a very different decumulation strategy than those people who have a gap. There is no right or wrong answer. There is just, what are we doing for the problem? So this is a typical scenario, and I'm going to be wrapping up in the next 10 or 15 minutes, so please just bear with me. 10 minutes, I promise. So you come in, this blue line is your mortgage. Let's say you're on track to be mortgage-free by 65. Most of us aren't, but let's say you are. At that point, your KiwiSaver is paid out, or you can access your KiwiSaver, and living the lifestyle to which you were used to, but without mortgage payments, that normally lasts about 5 years, which is good. But we need to get you to 90. So we're kind of about 20 years short of what we need. And of course, you could live smaller, you could downsize your home, but there are levers you can pull. So I'm not saying there aren't things to do, but they can be uncomfortable and often not something you would want to do straight away. You know you can do it, but you don't necessarily want to pay your joker card straight away. But that's your cash position. So I'm looking at that and I'm thinking, okay, how much does that 20-year gap, what are we short by? And that's what I need your equity to solve for us. But before I worry about your equity, I want to get you a bit leaner because you're making your situation look worse than what it is. It's sort of in the absence of a plan, you're going to run out of money about 5 years after you retire. But with a plan, and if we're going for it, I actually think we can get you mortgage free in 10 years. I know that because that's what we've done for all the other clients on average. And then we say, okay, well, if we're getting you mortgage free at 55 rather than 65, that's 10 years of saving. And you invest that, like they can go and manage funds or whatever it is, but 10 years of money being left over accumulating. However you invest it is kind of irrelevant. With that money, you then get your KiwiSaver paid out on top, and that improvement, so that getting us leaner and mortgage free earlier and then saving for retirement, that buys you another 10 years of retirement. And so now the gap that I actually need to close, I need to make sure you actually achieve that. But then I need my wealth gap to close the difference, which is, in this case, is only 500,000. And remember, only 38% of people coming up to retirement in the 5 years before retirement, in the 10 years before retirement, are on track to be mortgage free, right? So that's the vast majority of us aren't. So we're going to have to rattle our dags, and we're going to have to be smarter with our money, but then we need our money working harder as well. So I look at this, I'm like, well, I'll get you leaner, I'll do all the rest, that much I'm comfortable, irrespective of interest rates, irrespective of government policies, we can do that. That's what there's enough control for us to play your hand right for that to happen. But the next thing is, but how do we solve that wealth gap? Because that's what your equity needs to do for us. So the idea of leverage is accessing your equity to buy another asset and for you to borrow the value of that asset. So, and as it goes up in value, you haven't had to put much money in. The bank have put the money in, but you get to keep 100% of the gain. That's the disproportionate return. So I'm going to give you an example of what that looks like. If you had $160,000 to invest, you could put that in a managed fund. And on average, I'm going to say you'll get a 6% return. So at the end of the year, you have $9,600 of value. So perhaps that fund is now showing it's worth $170,000. And look, there's volatility with that. This is just what we're smoothing it out to be, perhaps over a 10-year period. If you had that $160,000 and you bought an investment property, the right one, you would be having a mortgage on that property of $640,000. So you bought an $800,000 property, you've used $160,000 of cash, you've borrowed the difference. That property on average goes up in value 6% a year on average. You've had to pay a top up each week of $60 to cover the shortfall between the rent, the interest, and the property costs, like the property manager, insurance and rates and all of those things. And this is assuming a 5% rental return. But under that scenario, you've made $45,000. So for the same amount of cash commitment, well, actually it's slightly more for property, it's an extra $60 a week more, but the initial deposit for either of those options, one, your money is working a lot harder. Now, there are a lot of downsides with property. I'm not saying that it's the right thing for you. We need to go through a process to determine that. And provided you don't need that money back within 5 years, it could be. If you did need the money back within 5 years, then we would strongly recommend something else. But this is an example of, well, if you can structure it correctly and if you can minimize your exposure and if you can afford to hold it for the length of a property cycle, that money works a whole lot harder than what you were doing just putting it in the bank or a managed fund, right? So there are a lot of lemons out there. I'm not saying that's not the case, but if we are looking at determining what your retirement gap is, and that slide before, I think we said that it was $500,000, I would be working out, well, if that's my gap, that's the problem I need to solve, how much equity do I have to solve that? And that will tell me the capital gain that I need to get on that property, which will then tell me the regions that I should consider investing in and the regions I should avoid. It will tell me what the rent needs to be, which tells me the yield, which determines the number of bedrooms, and whether that property needs to be attached or standalone. And you've got to take quite an objective assessment of these things and work out, well, what does your situation need? Don't find a property and try and shunt it in to solve the problem. Let's determine what are the components that are needed to solve your problem correctly. Because what will be a good property for you will not be a good property for someone else for a raft of reasons. So we just want to get clear on that. But here's an example of a client. I think this is one of the last kind of sections of slides. So Jim and Kathy, they came to see us at 51 and 55. Their retirement gap was 550,000. They bought an investment property in 2020. Purchase price was 665,000. The CV today is 860. So in that time, they've had $195,000 of growth. That hasn't solved the 550, but you can see that within the next 10 years, they are on track to solve that. For me personally, I like to double down. So I would be wanting to borrow against that gain and do it again. So take the money they've made and get it working harder. And the reason I would do a second property is because they might have kids that it could be a draw on their retirement vesting, or they might want to just help their kids. Or they might want to de-risk their situation, so have more than what they need, so that if the government did do something crazy like change the pension age or do all these things that they probably need to do, but don't know who or when will do it, that Jim and Kathy are going to be okay. They can navigate that safely because their level of resilience is strong enough. So look, if you're buying a property, you've got to be able to hold it for long enough. It's not the time that you enter the market, it's what's happening at the point that you exit. That's the most important thing, and provided you can hold it. There's a lot of things that can go wrong, so we don't try and romanticize it, but we try and understand what do you need to solve your problem and how can we ring fence the downside. And capital gains driven by a whole lot of things. It's the interest rate cycle. When you tend to have lower interest rates, capital gain tends to come off the back of that. The location of a property, the type of property, what's happening with our migration numbers, the timing of where we're at in the property cycle, government policy, i.e. overseas buyers allowed to come into the country. These are all things that have an impact, and we can't control some of those things, but provided you can hold the property long enough, you will get the gain. The risk or the unknown is, well, how long do you need to hold it for? And that's when, if we can get that cash top up to be as low as possible for you, your ability to navigate through the headwinds, which will invariably come over a 5 or 10 year period, will be okay. And remember, normally a headwind only lasts for 18 months on average. So we need to be able to navigate you through that safely. So if you don't want to get into property, and not everyone does, and that's fine, and not everyone can, then we would be looking at other options. So what are our term deposits or bonds offering, managed funds, shares, business, digital currencies? There's quite a lot of fun things in there. If you're trying to solve for your retirement and you've got a retirement gap, you're trying to balance the predictability or the probability of you getting the return you want with the return that you need. Right? So some of these things, they might give you a good return, but the probability of it happening, or it could be so volatile that your chances of cashing out at the right time becomes the biggest problem of all. We can work through those things. So a good plan, we're all about a good plan. You start with that, assess where you're at, design the plan, understand the problem to be solved, understand who you are and what you're not, so we can design a strategy to navigate those things or to embolden you in the areas where you are actually really good. We want to remove the inefficiencies, and most of our clients, I would say, are comfortably inefficient. Not bad with money, just a little bit meh. But it will make it worth your while. We want to create better systems so it's effortless, and this doesn't require willpower. We want you to be able to do the things that you love, so they're the first things that we factor in. But we also want to move you to a wealth mindset, which is different than a fly by the seat of your pants mindset. We focus on designing the right plan, and I think where the Enable Me team comes into its own is our ability to support you to execute on that plan. It's about clinical execution. And life throws curveballs because life's painful, but we want to be able to adjust and reset really quickly. And inaction, doing nothing costs. There's a bigger cost for inaction than doing something and getting it wrong and resetting. So you might want to ask yourself, is it the right time to start? Don't bother waiting till interest rates are optimal, even if they do. I mean, they're as close to optimal now as you're going to get. Provided we can exit you from whatever investment you do, as long as we've got a good 2 years runway to get that right, we should be okay. If you don't have enough for your retirement, the sooner we start, the more chance we will get enough. If you're left to your own devices, are you likely to do something? I don't know about you, but I'm very much find out who you need to hear the advice from for you to take it on board. It doesn't have to be me, it doesn't have to be enable me, but it's got to be someone, because we're navigating something pretty complex here, and emotions get tied up, and sometimes hearing the right message from the right person is the difference between you actually doing what you need to do or just pretending that it's going to be okay. I told my husband I want to get fit. Tell me if I don't stick to my diet, which we all know is code for don't you dare say anything ever about this. If he did suggest something to me on my fitness or my diet, even if he did it without a tone, I would be offended. But if my personal trainer said the same thing to me, probably with a tone, I wouldn't be offended, right? Work out who you need to hear it from so that you do what you need to do. And that's okay if it's got to be someone outside of your circle of friends or family. I would suggest if you're aiming for high performance, it should always be outside of that circle. Accountability. A coach is someone who tells you what you don't want to hear, who has you see what you don't want to see so you can be what you always knew you could be, right? Okay, key takeaways. Interest rates are great. Let's get a rattle on. Understand your tendencies. Pace is more important than rates. What is the pace that you're getting ahead? Are you on track to hit your goals? If not, let's bring our A game and let's start to unpack this for you. Here's our amazing team of experts that sit behind the Enable Me brand. So these are the people that you're working with, and yeah, I couldn't be more proud of them. Incredible team, committed to your success. If you do want to have a consultation with one of those amazing people, the cost of that consultation is normally $400. It's discounted to $149 if you take advantage of it tonight. I think if you take until Friday to take advantage of it, it goes up to $249. So I would say book in for a consultation. That consultation goes for about 90 minutes, 60 to 90 minutes. You and your partner will both need to be there because it's their fault, right? We want to understand where you're at. We're not going to labor the point of why you're not where you need to be. We just want to work out what's the gap, what's the most effective strategy to get this sorted. Are you ready to do it? And if you are, this is what it's going to look like. And depending on what the goal is, will determine the intensity of the plan. And the intensity of the plan determines what the right program for you should be. So our programs tend to range for people with mortgages from $5,000 to $10,000 for the first year. That depends on whether you're wanting to buy a couple of investment properties or not, or just focus on getting your mortgage paid off as quickly as possible. So that's sort of the spectrum depending on how ambitious you want to be. If you're not yet on the property ladder, I know that there were possibly 10% of people on this call that weren't on the property ladder, then we would have a more specialized program, but a smaller program that we'd be working with you on at a lower cost as a result. So I hope that all makes sense. And yes, we've got some questions. So I'll leave that slide up, and Amelia, hit me with some questions.
Yeah, we've got some great questions that have come through. The first one is, I'm 47 this year. Is it too late to start? My mortgage is small, and if I can, I'd like to do something with the equity in my house.
You're a spring chicken, babe. 47's awesome. If you're 67, I might have hesitations. No, this is a really good time to start. The bank's willingness to lend to you probably peaks at about 57. So anything that we can do before that is incredible. And there's still things we can do after that, but 47, easy. And this person didn't say whether they were a guy or a girl or in a relationship or not, but please don't think that you need to be in a relationship in order to get these outcomes. If anything, sometimes a relationship can be a setback for trying to build momentum. So, yeah.
Our next question. In the past, I was told about splitting the mortgage with revolving credit and fixed term, then using credit cards for all expenses and paying them off at the end of the month. But now with credit card fees everywhere, is this still viable?
Not usually. Certainly not if you're a shopper. The risk that it's a true sentence to say that if you live off your credit card and the revolve, and even if there weren't fees in this situation, this is what they used to say, live off your credit card and then pay your credit card at the end of the month, and the interest you save on those 30 days of no interest on your credit card, with that money not being on your mortgage, that saves you a bit. And maybe it saves you $10 a week in interest that you didn't need to incur. But so that is true. What they fail to say is that on average, you are more likely to spend more than what you save because you have used a credit card. So no, I don't believe in credit cards as a general rule. I mean, they can be a convenient payment, certainly of bills, but in most instances, for non-bills, your discretionary spend, including food, using a credit card is the easiest way to introduce fritter. But certainly with the fees that they pay, that they're charging, there's normally $1,000 to $2,000 of cost spending that gets absorbed in that, just with the fees each year. So no, I don't believe in having a credit card for all of those costs. Our behaviors don't match it. And the only person who I'd allow to do that would be like a hard out saver. And they probably wouldn't have a credit card anyway because they are a hard out saver.
Do you have any advice for homes that require renovations and how to balance this with paying off the mortgage? My experience has been that we make progress on the mortgage, then borrow off for the renovation.
Yeah. Yeah, it's a bit of a pill, to be honest. Because the worst thing that happens there is that you never get the sense of getting ahead. So you get a little bit of progress, but then you spend that progress on improving the home, which in theory creates equity, sort of, but it also normally creates more lending. If you're so a renovation can work out cheaper than selling your home and buying another one. So there's sort of all these things to work through. So on the assumption it made sense to do that. Your home is a largely unproductive asset, so you want to minimize the capital tied up in that property. So for some clients, I've said, look, what is the real need of this renovation? Could we perhaps do it in stages? And do we do one stage, maybe buy an investment property, get some capital gain on that property, sell it or borrow against that's tax deductible to then help fund the renovation. So it could be just reordering or breaking it down into chunks so that we can reorder it. If you're about to do something unproductive, I mean, some people would say don't do anything unproductive. That just isn't how life works. I take the view, if you need to do something because it's important to your family, yourself, whatever, why don't we try and neutralize that with a more ambitious wealth strategy? Right? So instead of kind of saying, well, I'm going to do something unproductive, which is unproductive, and then that grind your wealth creation to a halt, which is like a double bad, I would prefer to try and neutralize the unproductive nature with being kind of more aggressive on the other side. It comes down to your appetite. It comes down to how big the renovation is. But some people do overcapitalize or make it really hard for themselves by tying up all their cash flow in a renovation. And I'm not convinced it works out the way that it should in the New Zealand market. Yeah.
Someone said that they were interested to learn more about when is it the right time to unlock equity? How much should you pay down on your own property first?
Well, it's always the right time to unlock equity, but unlocking equity is making it available to you. If you're going to then use it once it's available, well, we need to have a mortgage strategy. And my preference is that your home mortgage is on track to be paid off within 5 to 7 years if we're going to be using that equity to grow wealth somewhere else. So there's sort of a few components that need to work together with that. But one of the reasons why I need to be mortgage free on your home is to de-risk the investment property. I need to start paying down the debt on that property as well. But I can't do that until I've paid off your home. So there's sort of a few things in there that become really important. So the more ambitious you want to be, we're very conscious about where your flank is exposed, and we work really hard to build resilience into this so that you can just weather any of the little curveballs that life will throw at you once you get started. Yeah. I'm conscious that we have gone for an hour, so I'm going to let everyone go. Thank you very much. I hope we see you in for a consultation. It's been really nice spending some time with you. Thank you.